In the free cash flow model for estimating stock valuation, we really want to look at a couple of things. We want to try to ultimately estimate what we think the stock price is worth, what the ultimate market value of equity is, and we want to kind of see where is the money going? How is it being distributed, the free cash flow of the company? So let's go back up here. What kind of information do we need? We need information about the weighted average cost of capital for the company. Now we're going to discuss this in the class, but there's a website you can go to that's called WACC.com. And when you go to that site, you link in or click in your ticker symbol, type that in, and it will go to a site and will calculate the weighted average cost of capital for your company. And one of the things that you'll get from that is the estimate of the cost of equity for this company. So we can utilize that information once we get there. We need to have some idea about the growth rate of free cash flow. We can do that with a present value calculation. Right here it calculates that 3 years ago it was 5,000, this year it's 6,500. That's a 9% growth rate. We could plug that number up above. Maybe we can get some forecasted information about how cash flows and earnings are estimated to grow, but we can again plug that information in there. But we do need to know where free cash flow starts. What is free cash flow today? And this model is very similar to the dividend valuation growth model. We need to know three things: free cash flow next year, we need to know the growth rate of free cash flow, and we need to know the cost of financing for the company. So how can we calculate beyond that, the other things we might need to know to fill out the rest of the information here is we need to know what is the market value of the company's debt. How much debt do they have? And how much cash is available? So from that we end up with a calculation of the market value of common stock. In this case, it's $133 million. They have 1.6 billion shares, or 1.64 billion shares. The value of their stock then, doing the calculation, is $79.98. Now we might want to know, well, where does this cash flow go? The free cash flow to equity holders. We start with free cash flow, and you subtract out the interest expense, and you subtract out any changes in debt, because free cash flow is distributed only to two people. It's money that can be distributed to shareholders, equity holders, or it's money that can be distributed to creditors. So we want to know the change or the net debt increase. In this case, debt went up $447,000. And again, this came from a financial statement. I don't really understand it, but it said that there was zero interest expense. I don't believe that, but that's what it says. This could ultimately be a net number too. So anyhow, this thing basically says that $6.9 billion was distributed or could be distributed to shareholders. How do we ultimately then get the free cash flow to the equity holders? How do we calculate market value based on this free cash flow that's just available to equity holders? Again, we do the same basic information. We have a cost of equity. We have the growth rate that we forecasted as far as cash flows growing. We have the free cash flows going to equity holders. And again, this gives us another calculation that says the market value of equity is about 115. I guess this is I think there's 3 zeros, so it's $115 million. So it's very close to the market value up above. So the numbers come out pretty close in this instance. But again, we'd like to be able to see how you can ultimately move to figure out what you would be willing to pay to buy the stock of this company. And this free cash flow model allows us to do that. Now, the pure model doesn't do a value per share. It tells you what it should cost you to buy the stock. If you bought the whole company, you'd have to pay $154 million. You'd have to spend $131 million on the stock. You'd have to spend $27 million on the debt, and of course you would have $4 million in cash that you could use to offset that value. So this ultimate value of the corporation is the stock of the company plus the debt of the company minus the cash flow of the company. We did a quick calculation here just to estimate what that would equate to in value per share. But if this is a sole proprietorship or a partnership, you really only need the market value to the equity holders of the company. This is what we need. So that's the free cash flow model. Hope you enjoyed that.